In this section, you'll learn how to understand the concepts of cafeteria plans, as well as calculate the net pay with them. This section also shows the necessity for HR and payroll to work together with benefit rules and their payroll deductions. So it's going to give you that solid real world understanding, as well as how to prepare for the CPP or FCP exam. This way you'll have a solid understanding of how the fringe benefits, retirement plans, and cafeteria plans, how these all come together from our last couple of modules and this one, and actually affect your net pay for every individual calculation. Since this section is relatively short, guess what? We may be able to skip our Friday session. Might be able to give you a day off. Wouldn't that be fun? Okay, so let's dive right in. The terms cafeteria plans, flexible benefit plans, or flex plans are used interchangeably, reflecting the methods used in providing employees with a menu of benefits with which they can make their selection of various benefit options. A cafeteria plan, as defined in the Internal Revenue Code 125, is a plan in which all participants are employees who choose from a minimum of 2 or more benefits that consist of each cash and qualified benefits. The value of those qualified benefits is not included in gross income. However, if a cash benefit is chosen, that is included in the employee's income. The flexible spending account, or FSA, are often included in cafeteria plans. These provide a mechanism that allows employees to pay for a certain medical or dependent care assistance expense with pre-tax dollars. Seems simple, however, cafeteria plans, flex benefit plans, and FSAs can be very complicated and must meet many specific requirements contained in the IRS regs. A cafeteria plan allows employers to provide a flexible benefits program that gives employees the ability to choose benefits based on their individual needs. That choice is made between taxable and non-taxable qualified benefits. Qualified benefits includes things like your accident and health plans, dependent care assistance programs, group term life, short-term, long-term disability, and the like. Benefits that are not allowed to be included in a true 125 plan include things like educational assistance, your scholarship and fellowship grants, rides in commuter vans, etc. And those are things we learned about a couple weeks ago that are considered taxable fringe benefits. So that's why they're not considered in a 125 plan. We'll see a longer list of these as you're looking at now is the longer list. The premium only plans are used by employers who require their employees to contribute toward their benefits like health insurance. POP or premium only plans typically do not offer a menu of benefits to choose from. It merely just allows employees to pay for their share of the benefit cost on a pre-tax basis. So it's really important to review and know the types of things, benefits that would be included in cafeteria plans and those that would not. These, I had several questions on the CPP that included whether or not items were considered a cafeteria plan. So it's certainly a good thing to know. Your Section 125 plan documents. The cafeteria plan must have a written document laying out the particulars of the plan, and it must be intended to be a permanent plan. The plan doc must include a description of the benefits available and their period of coverage. the plan's rules for how employees become eligible to participate, procedures for making elections, when those elections can be made, how long they're effective, when they can be revoked, all of those things. The manner in which contributions are made, such as are they salary reductions or non-elective employer contributions, a maximum allowed amount of employer contributions and salary reductions available to any participant, and the definition of the plan year. The rules governing cafeteria plans generally prohibit the inclusion of any plan that provides or allows deferred compensation. A cafeteria plan violates this rule if it allows employees to either carry over unused contribution or benefits from one plan year to another, like pre-purchase vacation days and things like that. Or if they use contributions from one plan year to purchase benefits that will be provided in a later plan year. Of course, there's always exceptions to the rule. Those special rules surrounding purchased paid time off are always going to be those exclusions or exceptions, excuse me. When a cafeteria plan may offer employees the option of purchasing additional paid time off with pre-tax dollars, that leave becomes taxable when they take it and is subject to several restrictions related to the ban on deferred compensation. The plan must prohibit employees from receiving cash for the unused purchased time off after the end of the plan year. Purchased paid time off may not be used until all of their regular time that's accrued has been used. Don't you just love all of the exceptions? Here are your 4 exceptions for deferred comp to be included in cafeteria plans. So when we talked about the fringe benefits and cafeteria plan or retirement plans in the last couple of weeks, now we're going to combine how those things flow into your cafeteria plan, when and if they flow into that cafeteria plan. Here's those 4 exceptions. Your cash or deferred arrangements under the Internal Revenue Code 401k, contributions to health savings accounts, which are HSAs, which allow contributions to be carried forward, carryover of $500 in a medical flexible spending account from 1 year to the next, and flexible spending accounts that allow a grace period of 2.5 months after the end of the plan year for the participants to incur their eligible expenses. It's important to note that plans may not have both the carryover and the grace period. Employer matching contributions are permitted in this type of cafeteria plan. Your contributions to a cafeteria plan. Cafeteria plans and other flexible benefit plans are typically funded by one of the following: flex dollars or credits. With this option, the available benefits are funded by employer contributions. So each employee is given basically a bucket of funds to use on various benefits. Or the salary reduction method, where employees use part of their own salary to purchase qualified benefits through pre-tax or after-tax deductions. Additionally, you can use after-tax employee contributions. This option allows the cafeteria plan the ability to offer after-tax contributions for qualified benefits. Another helpful hint: the plan cannot allow purchase of non-qualified taxable benefits with after-tax contributions. Employers may permit employees to participate in a cafeteria plan when they pay the cost of the benefit. If they pay the cost of that benefit through a deduction from their wages in pre-tax dollars. When an employer deducts an amount from the employee's pay for benefit, There's generally an authorization by the employee to confirm this deduction. This confirmation may be in any form the employer desires. This example here shows how to calculate the net pay with an after-tax deduction. You'll need to be familiar with how this net pay calculation works for both the after-tax and the pre-tax calculation. The important key to note here is where it actually appears in this calculation. So you can see your taxable wages, because Melissa is paid $2,000 semi-monthly, has $28,000 year-to-date Medicare wages. She claims single or married filing separately with no other adjustments. Obviously, when you read through these examples, you can tell there is some really unimportant information. Do you really need to know that she has $28,000 year-to-date Medicare wages? Not 100%, but yet if she was near those caps for your Social Security wages, it would be, good to know, as well as if she needed to pay that additional Medicare. But since this is an after tax, she contributes to a benefit plan in the amount of $100 per pay with an after-tax deduction. You can see that after-tax deduction is calculated after all of her taxes, and that's where that net pay number then comes from. The tax treatment and reporting is our next little area for our cafeteria plans. If a flexible benefit plan qualifies as a true 125 cafeteria plan, certain tax benefits are available to employees who participate in that plan. The employer contributions to a qualified cafeteria plan are excluded from the employee's income and are not subject to federal income tax withholding or employment taxes to the extent the contributions relate to the non-taxable benefit by the employee. So when your employer contributes to your medical insurance, your wages are not increased to account for that employer contribution. It is noted for W-2 purposes, but you're not charged tax on it. Pre-tax contributions or salary reductions made by an employee to a qualified cafeteria plan are excluded from the employee's income. They are not subject to federal income tax withholding or Social Security, Medicare, FUTA, whether the benefits purchased are taxable or non-taxable qualified benefits, except of course your 401k, which we learned last week. Any taxable benefits purchased become taxable when they become currently available to the employee. Pre-tax contributions do not reduce the amount of taxable benefit that must be included in the employee's income. Pre-tax contributions made by an employee are considered to be employer contributions when you're determining the rate of that taxable value of the benefit. Your after-tax contributions are contributions toward benefits made with after-tax dollars, and those are included in the employee's income. They are subject to federal income tax withholding, Social Security, Medicare, and FUTA. The benefits purchased, however, are excluded from the employee's income. So they're paying those taxes on the actual wages because the benefit is paid for after tax, but you're not increasing their pay based on that benefit. A cash item, if employees choose to take cash instead of purchasing benefits with their flex dollars, those payments are considered wages and are then, of course, subject to your federal income tax withholding, Social Security, Medicare, and FUTA. Same holds true for paid time off that is cashed out because the employee feels they will not be able to use that time before their year ends. Discriminatory plans are quite similar to what we learned in our 401k last week, or retirement plans. Discriminatory plans are plans that discriminate in favor of your highly compensated individuals, employees, participants, or key employees. Are not disqualified though, and do not have negative consequences for the other participants. But those highly qualified or highly compensated or key participants do lose the tax benefits of the plan and are subject to paying proper tax. This table above gives a really good quick glance at each type and its taxability for each type of federal tax. Keep in mind, none of this refers to your state or local tax. So it's really good to know that your employer qualified benefits, they're not taxable for anything. But if you go down to a discriminatory plan at the bottom, yes, for everything. And of course, in the middle. If an employee pays pre-tax, no to federal withholding, no to Social Security tax, and so forth. This is a pre-tax contribution calculation breakdown. It's really important to take note of where the deduction sits in relation to calculation for each tax. So as we saw before, that calculation sat right above the net pay. So that was the very last thing that you were deducting. Now we're doing the calculation twice, essentially, because we're taking it out, that cafeteria plan amount, we're going to reduce their gross wages in purpose of calculating that federal income tax. And then the wages for Social Security and Medicare are, of course, going to be the full gross pay. Oh, excuse me. No, it's not. You can see how everything is calculated separately. This will be a question on your CPP, so make sure that you have a solid grasp. And we do have some calculations later tomorrow that we'll be able to go through together. First pop quiz. Which of the following statements is true regarding a Section 125 plan? If you guessed employer contributions taken as cash represent taxable compensation, you are correct. The IRS rules require Section 125 benefits received in cash from a cafeteria plan to be included in the employee's income. Super important to have a solid grasp on. The tax treatment and reporting requirements. Aren't you enjoying this? IRS gives us so many fun rules to go through. The reporting requirements are generally pre-tax contributions to a cafeteria plan do not need to be reported by an employer on the quarterly 941 or an employee W-2 as taxable wages. The annual Form 940, however, these contributions are included in Part 2, Line 3 in total payments, then again in Part 2, Line 4 as exempt payments. Don't worry about memorizing the piece of this right now. Melissa will go through it more thoroughly during Module 7 next week. Taxable contributions and benefits are reported as they would be if they were provided outside the plan. Cash or deferred arrangements, elective contributions to a 401k plan may be made through automatic enrollment. The employee's compensation is reduced by a fixed percentage, which is then contributed to that 401k. When such pre-tax contributions are part of a cafeteria plan, the employee elective deferrals are not subject to federal income tax withholding, but they are subject to Social Security, Medicare, and FUTA. Therefore, they must be reported on W-2, box 3 and 5, with, of course, the amounts withheld in 4 and 6. The elective deferral would be also reported in box 12 with the code D. Your dependent care assistance. When an employee contributes to a dependent care assistance flexible spending account through either pre-tax or flex credits, the employer must report the amounts on the employee's W-2 box 10, with any excess over $5,000 also reported in boxes 1, 3, and 5. So, can your employee revoke their existing election? Generally, employees must make an irrevocable benefit election under a cafeteria plan before each plan year begins. Changes or revocations during the plan year can usually be made only under limited circumstances. The IRS regulations clarify a cafeteria plan's rights to permit employees to revoke or change an election during a plan year based on a change in status. Things like marital status change in dependence, employment status, things like that. Here are all the permitted changes to a cafeteria plan. Again, as I was saying, the marital status changes, your marriage, divorce, death, separation, change in number of dependents, whether it be birth, adoption, placement for adoption, or death, employment status change in dependent status, did they age out of the program? Residence change, adoption, again, commencement or termination of adoption proceedings, and eligibility for health for their marketplace purchases. We have several examples here of how you know whether or not the change is allowed. Your employee Susan, a single parent, elects family health coverage under her employer's cafeteria plan to cover herself and her 26-year-old daughter. Charlotte, who is in her final year of graduate school. When Charlotte graduates from college during the year, Susan wants to revoke her election of family coverage and make a new election for single coverage because the health plan does not cover adult children over 26. The cafeteria plan may permit this election change since Charlotte's loss of eligibility is a change in status and Susan's new election is consistent with that status change. Helpful hint to go through these examples and really understand how a change is allowed, what ways you can be permitted to make any kind of election change during the plan year. Questions on the CPP or FCP will be worded in different ways, but the meaning is still there. And as long as you know those solid reasonings behind how they came to the determination if a change was allowed or not, you'll have no problem. So changes due to cost or coverage. Similar to the other rule exceptions, there's also special exceptions regarding those change of statuses. The regulations include several exceptions to the change in status requirements to comply with mandates and other laws governing the availability of health insurance coverage. And this is why it's so crucial that your HR departments and payroll departments kind of mesh together and work together because these HR laws and payroll really overlap. So COBRA. If an employee, spouse, or dependent becomes eligible for continued health coverage under the employer's group plan, under COBRA or a similar state law, the employee may elect to increase their payments under the employer's cafeteria plan to pay for that continuation of coverage. A medical support order. If a court or agency has issued an order requiring accident or health coverage for an employee's child, the cafeteria plan can change the employee's election to include that coverage. Most likely child support orders that include that medical support order, of course you're going to want to, take a quick gander at that. Medicare or Medicaid eligibility. If an employee, spouse, or dependent who is covered under an employer's group plan becomes entitled to coverage under Medicare or Medicaid, the cafeteria plan may permit the employee to revoke coverage for that person. Special enrollment rights under HIPAA. If an employee has a right to enroll an employer's group health plan to add coverage for a family member under the Health Insurance Portability and Accountability Act, or HIPAA, because other coverage was lost, the plan may permit the employee to make a conforming election to add them. Elective deferrals under CODA. The regulations make it clear that a cafeteria plan may permit an employee to change or revoke elections regarding those elective deferrals to a 401k plan or an employee contributions governed by a 401m in accordance with those sections. So the election revocation restrictions of section 125 would not apply to the CODA plans. FMLA leave changes. An employee on FMLA leave may revoke or change an existing cafeteria plan election of group health plan coverage. Changes due to cost or coverage change. The IRS regs allow election revocation with respect to changes in the cost of coverage of qualified benefits. Election changes may be made to reflect significant cost or coverage changes for all types of qualified benefits provided under a cafeteria plan during the year, such as if the cost increases or decreases, requiring employees to change their payments. The cost of the benefit package can change, causing employees to change their level of coverage, or their dependent care cost changes. So the change can be to any of the following: the cost of the benefit plan, the cost of the package, cost of dependent care, daycare cost changes. Someone needs to then change what they have going into their FSA. They can do that. They need to change what coverage they have, unable to afford the increase. Here's another example, a set of examples that give you a really good understanding of whether or not those changes are permitted. So especially look at item number 1 or example number 1. Widgets Inc. has a cafeteria plan under its union contract that offers indemnity health insurance and a health FSA. After mid-year contract renegotiations, the premium and office visit copays for the indemnity insurance are reduced and an HMO option is added. The cafeteria plan may automatically decrease the amount of salary reduction contributions of plan participants by an amount corresponding to the decrease in premium, but it may not permit employees to change their FSA election to reflect the reduction in copay amounts. The plan may allow employees to change their elections and elect the improved indemnity plans or the new HMO options, but not to change their FSA elections to reflect the different amounts. So again, really crucial to understand the whys behind what's allowed and what is not when it comes to making those changes. Participation requirements and non-discrimination testing. So just like we learned last week in our deferred compensation plans, there are requirements and testing that cafeteria plans must also go through. Cafeteria plan participation must be restricted to employees, including former employees, but not self-employed individuals. To qualify for favorable tax treatment for all plan participants, the plan must not discriminate in terms of eligibility, contributions, or benefits in favor of those highly compensated individuals or participants or key employees. Your highly compensated employees, as we discussed last week, would be those corporate officers or shareholders owning more than 5% of the voting power or employer stock, making $130,000 in annual wages, or being a top 20% paid category, or the spouse or dependent of one of the above. Key employee includes corporate officers with annual compensation of $185,000 for 2020, your 5% owner, 1% owner whose earnings are greater than $150,000. Those non-discrimination tests required for a cafeteria plan the cafeteria plan must satisfy are an eligibility test, contribution and benefit test, which each participant must have an equal opportunity to select a non-taxable qualified benefit, or the concentration test, where qualified non-taxable benefits provided to all key employees do not exceed 25% of the benefits provided to all employees. So your flexible spending accounts. Flexible spending accounts are something that you'll want to take a look at every single year to know what the value is that employees are allowed to have. Flexible spending accounts often have a use it or lose it option. Some of them offer a grace period where you have an additional 2.5 months after the end of the plan year to use those monies. Or some offer a $500 limit carryover. So if you didn't use all of your contributions, instead of losing all of it, it would keep $500 in that plan as a carryover amount. The maximum amount for an FSA in 2020 for a salary reduction is $2,750. We have another pop quiz. An employee has elected to have $200 per month contributed to a medical flexible spending account. At the end of the plan year's grace period, $100 remain in the account. What happens to that $100? So if you elected on item D, the employer can use the amount to offset any administrative expenses in connection with the program, you'd be correct. Any amount in a health FSA that remains unused at the end of the plan year generally is forfeited by the employee. When an employee loses contributions at the end of the grace period due to the failure to incur eligible expenses, the employer may use the lost amounts to cover administrative expenses or allocate on a uniform basis to eligible employees for the next plan year. When using the $500 carryover provision for unused amounts, the cafeteria plan would have to be amended if the amount is paid to the employee as a refund, such as it would then be included in the employee's income. So I'm about 10 minutes short of concluding for the day. Do we have any questions?
I don't think there are any questions. I don't have any. Nobody else has submitted any of them.
I didn't think so either. I just wanted to give everyone a second. I know it's been all of these regulations coming at you for the last couple of weeks, and you hear this deferred compensation, taxable compensation, deferred contributions, and cafeteria plan and fringe benefits. You hear this kind of monotonous phrasing, and it gets kind of confusing. And I just want to make sure that everyone has a solid grasp on it. I think the best advice that I can give is that you make sure you understand how those calculations come into play. That's going to be huge for the test, making sure that you understand, pardon me, how to calculate out that net pay for any, whether it's 401k or fringe benefit or these cafeteria plans. Make sure you understand where it fits in that calculation. Then you'll have an easy time. And then if you also go through the examples and understand what it is that it's asking you, if it's wanting you to understand the hows or whys, or exactly what those examples are trying to teach you, because that's how the questions are kind of derived. You won't see any of the exact same scenarios, but they'll be worded with those similar definitions of why is this allowed or why is this not allowed type thing.
Okay, I do have a question. So it looks like with retirement plans, it was different. If it was a pre-tax contribution, it was pre-tax for federal, but not for FICA and Medicare. But when you have a pre-tax contribution to a cafeteria plan, it is pre-tax for federal and for Social Security and Medicare. Is that correct?
That is correct. And it makes no sense to me. You would think they would handle them the same way twice, and they don't. The only thing is then when you're receiving that 401k, once you do retire and you're drawing on it as income, you're receiving a check back that you're only then paying your federal income tax on, whereas you don't. That's not how a benefit plan for your health insurance type thing, those don't work that way. It's not like you draw funds back off from them.
Okay, so it makes sense when you say like retirement plans are either going to be taxed now or you're going to be taxed later.
Correct.
Whereas with cafeteria plans, if it's really a qualified cafeteria plan, you're not taxed now and you're not taxed later.
Right.
Okay. Thanks. It helps like talk that one through.
No problem. No problem. Well, we have like 6 minutes left, but if we have no other questions, we'll be ready to start tomorrow. Let me find the next slide here. Tomorrow we will continue with those FSA rules. And tomorrow we'll have just about the same number of slides, so it might be 5-6 minutes short again tomorrow, and I really don't think we'll have to worry too much unless there's a ton of questions. We should be able to give you a break on Friday before we start into the nitty gritty. How do you report now that you know how to calculate all of these things? How do they flow into your 940, 941, your W-2s? And when do you have to make all of those payments? That's what we'll jump into next week.
And I will say for tomorrow, I sent out a link to the worksheets to help you go through the federal income tax. So if you want to practice the calculation, we're going to go through a couple calculations tomorrow, but you can make sure you have that worksheet ready. Again, I sent out a link so you can either download or open it up just so that you can follow through yourself if you are wanting to do that practice.
That's great, Manon. Thank you.
Hey, Manon, when did you send that email?
Oh, goodness.
Do I need to go look for it?
I think I sent it Friday. Let me go and I can resend it out to everyone.
Okay, that would be great. And then just for our regular monthly study groups, are you still working to get those RCHs sent out?
Yes.
Okay,
Yes.
sounds good.
Yeah.
Just making sure I didn't delete anything. I should
Nope.
have.
It's
Okay.
still on my to-do list. So I haven't done
Okay,
it
that's
yet.
fine. We had a lot going on last week.
Yeah. Okay. Thank you.
Thanks.
Okay. Well, everybody have a great day then.
You too. Thank you.
You're
Thanks,
welcome.
Rebecca.
Yep. Bye.
Bye.